You're testing more, is that?
More than.
Hello, good evening everyone, ladies and gentlemen. Welcome to another Ask Me Anything webinar presented to you by FSMOne. My name is Yit Hong. I will be your moderator for tonight. So we do have three guests with us today. So we will start from the left. On your left, you will see Kevin over here from research team. He's actually from research team, and today he will be sharing from the research viewpoint to us, and he will be addressing some of your questions, some of your burning questions tonight, okay? And in the middle, we have Jerry, which is the managed portfolio manager, portfolio management that oversees the managed portfolio team, right? And also you have Kinon. Kinon is actually the manager of equity and ETF department. He also oversees the fixed income department as well. So he's basically a product specialist right here. All right. So we are happy that you guys are joining us today, and for all of our Muslim clients, hope you guys are having your dinner right now, and also selamat buka puasa. Okay, so let's get into your burning questions, shall we?
Yeah, sure.
All right. So I am actually, we are happy that we get a lot of questions from our viewers here. Basically, I would say there's a lot of interesting questions, but most of the questions are actually revolving around the issues that are happening right now. So we will start with the first one, which is the US market. All right. So I believe that all of you guys, right, when you are turning on your phone, checking on news, right, any of the news sources right now, you will see a lot of news flying around talking about tariff risk, right? So I believe this is also one of the main things that bothering you guys. Okay, so perhaps we can start with Kevin. Because right now, what we do see is that there's a 25% tariff being imposed by President Trump, right? And the 25% is actually imposing on Canada and also Mexico. And also additional 10% on China markets. So what do you see that, are we actually in trade war 2.0 right now? And also for this tariff, right, is it going to affect, is it going to improve the economy in the US, or is it going to make it worse? Yep.
Okay, well, when we are talking about the investment landscape in the entire year of 2025, basically we are surrounded by two T, Trump and tariff. So basically, what's so special about this President Donald Trump is he is a guy full of uncertainties. Even some of the, if you look at around the market, some people are saying that he did a lot of nonsense stuff. But actually, take a step back and look at what Trump did to the economy. Well, his aim is pretty sure, pretty certain for us, which he wants to make America great again by tariff. Well, what US have compared among all the global peers, US is having a superpower. They are dominating in a lot of sectors, a lot of industries. Look at technologies, look at their currency system, look at a lot of their banking system. They are much more mature compared to others. So this is what powerful of US is. So Donald Trump, he's trying to utilizing on all these resources and trying to make America great again by tariff. So again, back to your question, are we going to witness trade war 2.0? My answer is probably yes. So being an investors, we need to embrace this kind of volatility. Next, how should we address this kind of issue? Again, like what I mentioned just now, embrace the volatility by having a portfolio is the best case. Because ultimately, we believe that it is very, very tough for us to gauge whether Trump will have a softened stance, or maybe tomorrow Trump will even have more surprise to the market. Like what I mentioned, full of uncertainties. So the only way you can manage to overcome this kind of issue is stay invested. So yeah, we are going to witness the trade war 2.0, and my advice is stay invested.
Okay, so stay invested is what Kevin is actually suggesting to our investors. So would you say our investors shouldn't be too worried about it, about the tariff risk, from all those new policies being implemented by our new President Trump?
Okay, to be honest, we should worry about it because, again, uncertainties. So I just want to re-highlight what I mentioned just now, why we encourage investors to stay investors. Let me bring you back to during a COVID time. We all know that throughout the COVID time, we have witnessed a V-shaped rebound. because of people are starting to realize about, COVID is not the doom, it's not the catastrophic issue, and we are starting to normalize our life. On a hindsight basis, we have the answer. But during that moment, are you the one who already know, you are well aware that we are already at the bottom? Probably, I believe that most of the people, we don't have a crystal ball, so we can't accurately predict the market. But if you stay away from the market because you are so afraid of the uncertainties, probably you will miss out a lot of rallies since then. Again, back to today, we are also witnessing the same uncertainties. How to overcome? That's why stay invested is crucially important here.
Yes, I actually agree to that. And also, I think Kevin actually addressed some of the questions from our viewers, right? A lot of our viewers actually asking, when is the right time? When is the market, when is the bottom of the market right now? So the answer, there you have it. Stay invested, keep invested, and also, time to time monitor on your portfolio a little bit, review on your portfolio for a bit, and also make the right decisions. Yeah. So for this tariff, right, Jerry, I believe as a portfolio manager, you are actually managing a very huge investment, a very huge portfolio right now, right? So I would say the new tariff might actually lead to some concerns to our investors, which is the recession risk, right? So given that the tariff might actually increase some of the costs, importation costs, right? And it might lead to a situation where the inflation rate might actually, increase again. So the Fed has been spending a lot of time trying to tame the market, trying to control the interest rate. But in this situation, right, when the inflation costs might actually increase, so how would you say that, is this going to push US market to a recession even further? Or is it going to have some sort of, they will actually implement another measure to tame the market again?
Okay, I think there's two parts of questions in the questions that you posted here. First one, maybe I talk a little bit about the tariff. If you're looking from a tariff perspective, I think what Kevin mentioned just now, I think one of the good things for you to, you won't be able to avoid, but you will be able to mitigate some of the tariff risks from the policy perspective, right? I think one of the things that we have done to our portfolio is that in early of this year, we actually increased exposure to China A. And if you look at China A perspective, right, when you look at economy perspective, which are the economy will be affected by tariff, you look at how relevant or how related the economy towards trade activity. And if you look at China A perspective, a lot of the China A listed company, they are more domestic driven, they are more consumption driven. So those are the companies that won't really be affected by tariff. And one very good example is that if you look back in 2018, that period during the trade war 1.0, these are the companies that fundamentally they are less impacted by tariff. So that's what we have done on a portfolio basis to increase from China A to. We won't be able to avoid, but we try to mitigate some of the tariff risk. That's one thing. Second thing is also, if you're looking at the US perspective, right? I think why Donald Trump keep on shouting that tariff is something good for America, will make America great again, it's actually on a relative basis. If you look at US economy, the key driver for US economy compared to the rest of the peers, for example, your Mexico, your Europe, and the rest of the peers, right? US economy is also more driven by domestic consumption. They are less sensitive toward trade compared to the peers that he is imposing the tariff. So on that perspective, he has an upper hand. That's why from our perspective is also we also overweighting on some of the sector, for example, technology. Those are the ones that on the other end, they won't be able to, I say, you won't be able to avoid, but you can mitigate some of the risk by having exposure towards this kind of a sector. So that's one of the that's part of it to address part of your questions, right? The other thing is about inflation risk. I mean, at this point in time, we are not seeing any substantial sign that inflation are spiking again. In fact, if you look at a lot of the recent data, we are seeing inflation coming down. So it's actually built a very good background for some of the aggressive, some of the more growth-oriented kind of a stock over the next 6 to 12 months period. So for now, we don't see that risk, but we are continuing to monitoring that inflation environment in the US perspective. Of course, we are also seeing that, if you look at the current monetary environment, we are also seeing a very good case for Fed to start considering perhaps it could be more rate cuts in the year of 2024 as compared to what market is expecting, probably about 2 rate cuts this year. So I think the current environment with valuation coming down quite a fair bit over the past few weeks, right? It built a very good ground for the equity market as a whole.
I see. So I would say Jerry has a very, I would say fairly positive view on US equity right now, right?
Yeah.
I understand. All right. So just now, I think you did mention about the US tech sectors, right? About US technology companies. And I do see that we have some questions coming in, which is actually asking about, NVIDIA and related stocks, right? After the GTC keynotes right now. So we actually mentioned something about no amazing news, like a magical news revenue stream.
Good to bad news.
Yeah. Is it equal to bad news?
Yeah. I think Kevin is doing coverage on NVIDIA. You want to share a bit on?
Coincidentally, I did some research on NVIDIA previously. And just to address your question, well, this week, one of the highlights is definitely GTC. The entire market are looking at NVIDIA because nowadays, like, if you still recall, just now I mentioned we have 2T, Trump and tariff. Actually, we have the third T, technology. So coming into the year of 2025, people are asking, is AI a bubble? Is those companies that invested heavily into AI, is this kind of trend sustainable? So a lot of people, they are focusing on the GTC. And I think one of the reasons that despite a lot, I would say that it's kind of positive news delivered by Jensen Huang, but the market has, the NVIDIA has also experienced a slight sell down. So if you recall, it's not just about NVIDIA. Even back then, I still remember, I think 2 quarters ago, Micron is also experiencing the same issue. If you look at the Micron, I think past 2 quarters, their earnings is impressive. Their guidance is good. It's awesome. But again, because people are expecting for more, people are crazily expecting for more. So this is one of the reasons that despite all these good fundamentals, Micron share price has fell since then. Again, nowadays back to NVIDIA, people are looking at NVIDIA, and I believe that one of the reasons, despite all these positive development, including the positive development of Blackwell, the positive development on the upcoming development, including Blackwell Ultra, including Rubin, including Vera, I think one of the reasons that people are expecting is the gross margin of NVIDIA. Well, gross margin is one of the issues that a lot of people are criticizing NVIDIA's for the past result, where NVIDIA's gross margin has fallen into, I think, about 70% compared to the market forecast of 72%. So people are worried about, can NVIDIA maintain its dominance in this AI landscape? Personally, I would think that the answer is yes, because like what Jensen Huang has mentioned in his speech, he has mentioned about one of the main reasons that slightly makes the gross margin lesser is because of the research and development cost in Blackwell. So our long-term view is the AI development is here, and we are still at a very early phase of the AI development. So being one of the most dominant player, being one of the most powerful player in the AI landscape, we believe that we have still a lot of upside potential for NVIDIA. So I would say that at this juncture, definitely uncertainties is looming, but any dip at this juncture, I would say that it's a buying opportunity for this stock.
I see. So it's kind of like we are having this positive view again on NVIDIA, on tech sector itself, right? Okay, so I believe most of our investors, our viewers here, right, they are getting most of their exposure in unit trust, right? But I think it's even more important to to gain exposure into this technology by using ETF, right? So some of the ETF, they are actually having more specifics towards certain sectors, right? So perhaps maybe Kin On, you can share a little bit on this one, because for ETF, I believe we had a discussion just now saying that ETF, they have a lot of specific one. Even they can actually track the very niche market, right? So is it actually a recommended options for our investors to go for ETF instead of focusing solely on unit trust itself?
I think, from the Malaysia perspective, I think it's definitely need to go look beyond just unit trust, specifically ETF. The reason being because in Malaysia, unit trust, the exposure are quite limited, right, as compared to a much matured market. So fundamentally, unit trust and ETF, they are the same. The concept is you give a sum of money, so the fund managers and the fund manager manage that fund on behalf, right? Of course, it's just a transaction manner is different, right? One is through the over-the-counters, submitting form. Of course, FSMOne we can do online, and then of course at the back there's someone doing the work, right?
Yep.
But as compared to the ETF, is mainly exchange traded, right? So in the US there's over 3,000 ETF, right?
Okay.
And also in Hong Kong there are over 2,000 of them. Yeah. So I have a slide here. Maybe I can show some classification. What do I mean by why should investors be into ETF other than just UT?
Yeah.
Yeah. So I think the why ETF is because the classification of ETF is so much wider, right? So I think from the ETF perspective, you can get exposure, all the range from geographical, sectorial, tactical, you can go long and shorts, you can go, alternative investment, commodities, you can even go leverage and inverse ETF, right? So you can even get exposure into precious metal. So, and just one thing that I really want to share with all the people on live is which is this. So this is a fairly new ETF that are being introduced in the market, right? So it's the name of the ETF is Kamalos S&P 500 Structured Protection ETF. So this specific ETF, the code is CPSR. I think everyone can actually bring up your FSMOne mobile apps and search for this, right? And you look at the investment objective, specifically the bottom line of this fact sheet. So this specific ETF have a maturity of 1 year. That means that it give this ETF will mature in 1 year. And what happened is that this specific ETF give a 7.63% upside cap. It's being capped at 7.63%. But the next question you're gonna ask me is, why would I invest something in cap, right?
Yep.
Because this specific ETF is 100% principal protected.
Oh, 100%.
Yes, the downside is 100%. But of course, that is based on the issue price that's being issued. Of course, the secondary trading, this specific one issued in early March, and then now, of course, it will mark to market based on the S&P prices. Now, of course, S&P goes up in price, and of course, this ETF also goes up in price.
I see.
So due to ETF allow, and also the matured of the ETF in the US and the Hong Kong market and the Hong Kong exchange, it give our investor a lot more options and exposure where UT cannot give you.
I see.
So I think our investors really need to consider about looking into ETF because it's just the format is different, but ETF allow you to go global.
Sure. Yeah, go global. And also for ETF, basically they are tracking the best, like the best performing companies, right? They are being selected to put into the index and representing the sector or even the countries, right? So that's why for ETF, it's definitely a very good way for our investors to expose themselves into the specific sector, and also they are investing into the best companies, right? Yeah. Okay, so since we are in the topic of technology, right, I believe a lot of our investors, and even also probably is also one of the reasons that attract you to join into our webinar, which is the technology development in China, right? So I believe Deepseek definitely is not a stranger name anymore to all of us, all of you guys, right? So for this Deepseek, right, since they claim that they use about 10% of the development cost of open AI, right? So I believe that there's two questions that are actually in the mind of all of our viewers, right? So one thing is whether Deepseek is actually going to drive AI development or innovation even further. And also the other thing is that the Deepseek itself, right, it has a capability to run, to deliver more performance at a in a more efficient way. Yeah, I'll put it in a more efficient way, right? So is it going to affect any of the technology companies that are currently in the US market? Because previously, I believe when Deepseek was launched or debuted in China, a lot of those technology companies actually went crashing, isn't it? Yeah. So perhaps I think maybe Jerry, you can share on this one also.
Yeah, I think if you look at the development on Deepseek, right, definitely especially if you look at the past 2 months period, there's also a key reason driving Hang Seng and Hang Seng Tech as a whole. Yeah, I think if you look at China markets so far on a year-to-date basis, right, the sentiment that have been driving China market is more on a technology perspective, on a Deepseek perspective. Instead of threatening the tech giant in the West, right, what I'm seeing is that they're actually creating a more competitive environment as a whole and push the competition and push the development even further. I think over the past few years, especially since 2018, Trump started the trade war, a lot of us starting to doubt whether China will be able to develop as fast because they are limiting all the chip supply, so on and so forth, that limiting the growth of China. But I think the development of Deepseek, on top of it, if you look at the development on Huawei over the past couple of years, right, since Trump imposed those tariff and also limit those supply to Huawei, I think those developments have illustrated an environment that China can actually grow even without all this kind of a supply. They can be self-sustained. I think that's also one of the perspectives we need to look at. And in terms of a portfolio allocation, I'm also seeing that there is a place for China or even China tech companies to be in investor portfolio without missing out the growth within the east side on the China perspective. Because when we talk about tech, I understand that a lot of investors who have been invested into, let's say, your Hang Seng Tech, your China Tech, so on and so forth for the past few years, you've been suffering losses. But I think if you look at the cycle of not only technology in every country, especially country that is emerging, coming out for, especially they are receiving so much of pressure and also all these kind of pressure from external pressure from the biggest economy. So I think there will be certain period that it will not growing as much as what investors are expecting. But what we are seeing is that the development is super healthy in the China perspective. You look at the tech development, you look at on the EV perspective, those are signs that showing us that China can actually self-sustain on the technology perspective. And from my point of view is that what I'm seeing is that the development and also the emerge of a Deepseek actually create a more competitive environment and start telling the West that without your supply, I can also self-sustain. I mean that's a key message I'm actually seeing within the development in the China segment.
I see.
Yeah.
So because just now you did mention that in your managed portfolio you have already put in some small caps China fund,
A,
right?
China A
shares, right? Okay.
Yeah.
Will you be considering on putting some China tech into your portfolio?
We used to have it, but at this point in time, we are not having it in the portfolio per se because I think the rally in the early of the years have been so fast, and what we are seeing is that the development over a mid to long term is quite healthy. But at this point in time, we are considering but not adding into the portfolio. For us right now, it's really on the China A share perspective, which is to reduce, like I mentioned earlier, to mitigate the so-called trade war risk. Because if we are looking at the Hang Seng company, Hang Seng Tech or Hang Seng company, right? Those are the company that is very much subject to the trade war risk or the tariff risk. So on a risk management perspective, right now what we are adding to the portfolio is more from the Asia perspective to mitigate the tariff risk.
I see.
Yeah.
Okay, so I do see that there's another viewers asking about China A shares because it seems to be lagging behind Hang Seng. So yeah,
China A shares still not even break even.
Since 3 years ago.
Yeah, I think a lot of I mean, if you look at on a 3-year perspective, not 3 years. I think the sell-off in China started, I think, somewhere in the first quarter of 2021. So it's about 2022, 2023, 2024. Now it's 2025 already. So about 4 years. I mean, the crash in the China equity market started from the technology crackdown, then followed by property crackdown, the regulatory crackdown. All those kind of things have been affected China markets. China A, I think we are seeing a very healthy development within the China A market. Consumption is picking up. Government is very committed to drive the consumption to drive the economic recovery. But bear in mind one thing, what is lacking right now for China A market is on the sentiment. If the sentiment come back as what we have seen in the early of the years, that within the technology segment, we will see a very strong rally in China equity market. Because don't forget that the Chinese people, they are sitting on a lot of cash. So there's plenty of liquidity, there's plenty of cash on the sideline. So one sentiment coming back, one confidence coming back, you will actually expect some rally within the China equity markets.
I see. That's where the dark horse coming in, right?
That's also why we identified China as dark horse for the year of 2025.
I see. Well, it's a very, I would say, it's also considered quite positive. It's just that we are lacking on some catalyst, right? Yeah. I mean, it is something that we have been seeing from the news as well. Even, I believe previously there's a news saying that the President Xi Jinping, they are actually trying to meet up with a lot of the leaders, like tech leaders, right? From the private sectors, they are actually meeting up. So I would say that it's also coming as a positive news for our investors. So back to the question, would you say buy, sell, or hold for China market? If there's a straightforward answer to that.
For me, it will be a buy. Yeah.
Oh, it's a buy.
For me, it's a buy to China market, especially China A share.
China A shares.
Yeah.
Okay. What about Kevin?
I would say that it's a buy as well, like what Jerry has mentioned just now. Currently, if we use a Chinese idiom, China is experiencing a scenario where 万事俱备，只欠东风, meaning that they have everything is ready. They are just waiting for the confidence to stimulate into the economy. So I would say that it's a buy for me.
Oh, a buy from us, right? Okay. Yeah. Again, Kin On, since you have more exposure in terms of the ETF, right? Will you say the China ETF is also something that we will recommend to our clients, or you would suggest that maybe they should, focus more on unit trust itself?
I think in terms of China exposure locally, in terms of UT are quite limited. So, and I think that the ETF space will have more option from that front. Yeah. So I would say that ultimately it really depends on the investor view. I think of course now we've been focusing on China tech and the China as a whole. I think these two main themes we are looking at, right? But of course, if the investor thinks that he wants to have a specific exposure over a certain industry, then ETF is where it will give that exposure. I think local UT don't have much variety on a niche market, right?
Yeah, if you are looking at sectorial level, then we don't have much. For example, if you're ETF, you have your China Semicon, you have your China EV, China consumer discretionary kind of ETF. But UT space, you don't have much. I mean, you have a broad China A share, you have a China small cap, you have greater China equity. So if investors are having specific view towards specific sector, then I think ETF will play a role. Yeah. But if it's just general China, I would say maybe UT still has an upper hand because because China market is still not as efficient compared to US, Europe markets, where broad market exposure, UT will be better, but specific sector, I think ETF will. I mean, that's the only option that you can get exposure.
Yeah, true. That's the benefit of like getting the niche market exposure from ETF, right? Yeah, I mean, of course, again, for all the unit trust or ETF, you can actually get it from our FSM website here. So you can actually just go through our, like ETF focus list. So from there, you can actually filter a few ETF that are being filtered by our research team, our ETF, and also the equity teams, basically. Yeah, so it will make it so much easier, and you can actually scan the QR code over here. This one. Yep. All right. So before we tap into another one, I would say, because again, when we are talking about China, right, there's China and also there's Greater China. So Greater China right now, they are also covering Hong Kong and Taiwan market, right? I believe previously Taiwan was the one who delivered most of the return for Greater China, and China was not performing as good, right? So moving forward, would you suggest to our viewers or our investors, right, maybe they should look more into China itself, or maybe still maintain the Greater China exposure? Perhaps Kevin can tap on it.
Okay, so basically you have already, already mentioned about the main difference between Greater China and China. Obviously, if investors want to gain exposure on the China itself, I think both are equally good. But just personally, I will go for China. Is because when we look at the Greater China, basically one of the main exposure is TSMC. Well, TSMC no doubt has been delivering a very impressive performance since year of 2023-24. And nowadays, if you still recall just now, I mentioned some of the tech giants, Nvidia, Micron, even AMD. Although fundamentally they are still good, their earnings impressive, but people are expecting much more for them. But take a step back. When we look back into China, year to date, China H share, China, those Hong Kong, they're really about 20+%. When we are at the start of the year, people are expecting this kind of performance from China? I would say that it's a no. And even if you look, because we speak to the market participants quite sometimes, and people are not really having the same view that China is back. Meaning that I will come up with a conclusion where I'm thinking that China still have a plenty of opportunity compared to the Greater China, where people are already starting to expecting more from TSMC itself. I mean, from basically the Taiwan exposure. So if I want to gain exposure, I want to gain the opportunity, I want to capture the opportunity from China, I will go for China itself compared to the Greater China. Yep, so that's my personal view.
I see. So you would suggest you will be focusing more on China instead of the Greater China region, right?
Yep.
Understood.
I think from what Kevin mentioned is that I think it's also something related to investment, the psychology part of investment. Because I think he mentioned one thing is that if this particular investment is something that everyone starting to have higher and higher expectation, the chances of it disappointing you is getting much higher and higher. So I think this is also something to share to our investor, right? We know that when you're looking at news, when you're looking at all the research paper, from time to time we will look at certain house or certain report tell you that this company is good, that sector is good, right? But when it comes to investing, we need to be a little bit more realistic. Things that is performing, particular sector that's performing, delivering strong results, strong earnings, right? If the expectation keep on going higher, it also means that the bar of failing to meet the expectation is getting higher and higher.
True.
So we got to be more realistic and need to be need to react oppositely. When the street is getting more and more optimistic on something, that's when we need to start to turn more defensive. And that also means that in certain times, not most of the time, in certain times, underdogs will have a higher chance to outperform.
I see.
Yeah. So that's also a key message to our investor that don't always chase for the outperforming, the best performing funds on a calendar year basis or more on a specific sector perspective.
I see.
Yeah.
So meaning to say, set a reasonable expectation so that it won't, if it goes beyond the performance, then of course it's additional gain. But if let's say it went further downwards, that's another good entry point, right? Yeah, because ultimately investment is buying at a lower price, selling at a higher price, right? So yeah, I mean, that's actually addressed it very, very nicely. And I think we do have some, the recent surge in Chinese stock, is it sustainable? Given that the background of low growth environment with lower purchasing power is as most of its people are hit with high household debts. Sustainability wise, if let's say again, just now Jerry did mention, right, the Chinese people over there, they are actually quite holding a lot of cash, right? So I would say that maybe in terms of the liquidity, it shouldn't be a very huge issue, right, moving forward. When there's a very strong catalyst coming in, that's where we will see the dark horse coming out, right?
Yeah, I think for China right now, the issue is more on the confidence level. The sentiment is not really good. People are not having a very high confidence over the outlook. But that doesn't mean that there's no growth potential. The growth potential is there. We are also seeing that there is a change in tone and style from the top tier of a government. So that's why when things start to shift, when sentiments start to come back, I think that's where the turning point. And we're actually starting to see there's a sign of China is recovering.
I see. Yeah, I think even from what we do see, again, from the news also, we can see that a lot of news saying that China is, coming back, they are slowly delivering good returns again, but still waiting for a catalyst. And let's just wait for it for a little longer and get the best catalyst from the market itself. All right, I think for now, after the Chinese market, right, I would say another very popular questions getting from our viewers, right, they are actually asking about Malaysia market. Okay, so Malaysia market, previously, I think it was one of our strongest recommendation, right? But looking at the recent performance right now, the market has slowly, dropping quite, I would say, a little significant at the moment, right? So previously, there's some very big title coming in saying that a lot of those multinational giants, they are bringing in a lot of investment over into Malaysia, right? Some of the names like Nvidia, Microsoft, Oracle, they are coming in, right? So with this tariff risk from the US market, right, do you see that they might actually pull their investment back out from Malaysia again? Is that something that what we can expect in the future moving forward? Kevin?
Okay, well, okay, definitely. Again, uncertainties. No one has the answer for that.
All right.
So I think one of the main reasons of Malaysia market has been plummeting for the past few months is because of the foreign outflows. When we look back to the start of the year of 2024, Malaysia surprisingly is one of the best performing market. Even at some point of time, they managed to beat those very large market like Nasdaq or even S&P. But recently, people are starting to lose confidence is because of Malaysia, no matter it's KLCI or even small cap or even some of the technology counters, they are facing this kind of bloodbath in the street. So again, if we look back into the data, we will notice there are three major parts of investors in Malaysian market. We have retailers, meaning that the normal people like me and you. We have institutions, which are the large institutions like EPF, LKT, QuAB, PNB. Those are the big local players we consider as institutional. Foreign, meaning that the foreigners. When we look into the local equity market, we are noticing that there are the divergence between the foreigners and also the local institutions. These are the main two players in the market. While retailers, just for information, is just a small part in the market. Foreigners, for the past few months, they have been fleeing out from the market is because of the uncertainties, tariff. Have tariff already significantly impacting Malaysia at this juncture? My answer is no, because people are just worried about the potential impact from tariff. But has it happened? It's no. Meanwhile, our local institutional players, you're going to find it very interesting because these players are the ones who are supporting the market. So we are seeing that foreigners, they are taking out the fund mainly. We believe that mainly because of two reasons. First, they are taking profit from the last year, the huge profit they have made. The second thing is because of uncertainties, meaning that once we have witnessed more certainties coming in, we have witnessed more certainties from no matter from US side or even some of the global peer sides. We believe that the foreigners, they might come back into Malaysia because just now we are talking about the equity market. Just now we also mentioned about fundamentally our economy. Those giants, those tech giants, they are still investing into Malaysia. And especially being a Malaysian here, we are already witnessing how Malaysia transformed from a kampong to nowadays we are already quite developed compared to a lot of global peers in the market. And we believe that no matter it's being an investor or no matter it's being a Malaysian, I believe that Malaysia, we are going to a right path because all the economic transformation, especially with the political stability, with the policy continuation, and with the clear direction set by the government and also from fiscal and monetary side, Malaysia is going through a right path. So, yep, I'm still positive on Malaysia, but at this juncture, we believe that foreign investors, they are fleeing just because of the uncertainties. And once the small certainties are coming in, we are going to witness a pivot for Malaysian market.
I see. So the main issue right now is actually the uncertainty, right? Okay, so if let's say we're talking about uncertainty, maybe we can actually tap into a little bit about certainty, right? Since we're talking about certainty, equity, definitely there's a lot of like ups and downs happening, right? Definitely a lot of investors, some of them like even more severe to a point where, you know, they cannot sleep at night. So why not we just tap into some of the certainty part, like bonds, right? So for bonds, definitely bonds, they have this feature of, you know, it can give you like a very consistent cash flow, you know, like they are actually, the nature of it is actually just borrowing money to companies or governments, right? So for bonds, is that something that for Malaysian investors, they should actually look into it? What do you say, bond team manager?
Yeah, I think definitely. I think you know, earlier on, Jerry and Kevin also shared a little bit about the uncertainty on the equity market, given you know the tariff implementation, you know, and also the geopolitical citizenship ending, the war part, right?
Yes.
So I think, you know, which I also mentioned earlier, I think some of the FSMOne investors, you're doing the what and where to invest. I've been saying that. In fact, earlier of this year, bond is an insurance policy that pays you, right?
Yes.
Basically, the bond is an instrument that will keep paying you coupon, right? So maybe you can bring up a slides, a historical performance. Yeah. So.
All right.
This is a US Treasury. So this is matured on 2047. I just simply pick one for example because during that time, all you know, US Treasury behaved the same, right? The prices all spiked up. So this is a price chart of a US Treasury. So you know, with tariff and uncertainty coming in, everybody was thinking, would there be a recession coming in, right? Yeah. So I think even Fed may not know at this juncture, right? So we have a FOMC coming 2 a.m. later. I think a lot of you know, market participants is, you know, focusing on that piece of news, right? So, but that's part of the uncertainty, right? So the recession fear, just similar. I think this chart covers from 2 years period. 2-year time frame, early 2019 and all the way to end of 2020. So you may see at the middle of the chart, they will see a strong spike on the bond price. That is actually during a COVID time. So lockdown, business is not running, people is not working, business is not generating income. So that is almost a similar behavior of recession, right? Because the economy is not growing in general, right? So inflation, of course, now we are talking about different environment, but inflation is not picking up, right? So that's the recession fear that we are talking about, right? So at that juncture itself, actually the bond price went up, right? So what happened is that if you hold into this bond, this US Treasury will continue keep paying you coupon, right? That's a core fact about bond. And this is the US Treasury. What are odds that US Treasury go default, right?
True.
Yeah.
Yes.
So being one of the safe haven, you know, on a global, I think US Treasury probably stand at number one, you know, in this case. So then if the equity portfolio comes down on a recession fear, right? In general, there's a sell-off. Then bonds is where it will spike in prices and recover that, absorb some of these equity losses for our client. Yeah.
I see.
And that's a certainty, that's the insurance policies that I'm saying that it will pay you.
Yeah. Wow, I think that one, this is actually a very interesting, you know, concept, saying that bond is actually like insurance policies for your portfolio, right? So having this bond in your portfolio definitely, you know, can provide some additional cash flow. And also, I think we used to have, previously we had this conversation about this insurance policy where when the market actually went down, your portfolio went crashing, you can actually get some coupons from bonds and use that money to kind of, you know, like further invest or top up, average down your portfolio, some of those good performing one, companies or unit trusts, right? Or even ETF, you can actually buy at a lower prices. So it definitely is a very interesting way to putting it, and also having bonds in your portfolios, right? Yeah, so I would say for now, because currently for bonds, I think Malaysian bonds right now is considered one of the safest one. and also one of the bonds that gives better rates, right? So perhaps also we can let our investors know that we have some bond funds as well, and also we do have some bond offering. Recently we have launched our new bond supermart live, and where our investors can actually trade bonds directly without going through any of the any of the counters. You don't need to go to any counter, you don't need to call any dealers. You can just straight away place your trades. Buying bonds is very, very easy. You can actually check out some of our US Treasury bonds from this QR code. Yeah, this one. Okay, so if we can go back to Malaysian market right now, I think this is one of the most asked questions, because previously we do have some bonds, the Malaysian equity funds recommendations, right? Last year, those funds are actually performing very, very well. Double-digit performance. I think you guys do know which funds that we are talking about right now. So previously, starting from this year, the year-to-date performance of the fund, right, has been quite disappointing at the moment. And recently, we do have our research team has this opportunity to talk to those fund managers, right? So, and then we also released an article mentioning about the outcome after we have discussed with the fund manager, right? Yeah, I think we can actually name it. It's actually from KAF. So perhaps, Kevin, you can also share a little bit from the discussion with the fund manager, because for now, I think most of the clients, they are actually questioning, or they are worried about why the performance has been dropping quite significantly since the beginning of the year. So perhaps you can actually share a little bit from what the fund manager has actually shared with us.
Okay, so regarding to this, one of the best performing fund in the year of 2023, it is $1 million question, because we have received this kind of queries for a lot of times, especially when the market is in red. So we had a discussion. We had an interesting discussion with the fund managers from fund house, and what we gained from the discussion is basically these fund managers, they are still positive to the market, and they are having a view that I think is worth for me to share with you, all of you here. I mean, if you want to have more details, feel free to read the articles. But because of time, for the interest of time, I just want to conclude the entire discussion into a few sentences that I want to explain here. The fund manager has mentioned about, despite the market is currently experiencing a drawdown, again, the fund manager encouraged people to stay invested. Like, if you still recall, at the first month of, when we just started this webinar, I also mentioned about we can't predict when is the bottom in the market. Although on a hindsight basis, we do tend that, at this point of time, if I manage to buy this, I could earn that much. If at this point of time, I sell it, I could take this much of profit. But definitely it's on a hindsight basis. When you are in the market, we are all human. We are easily influenced by emotion. So again, when the market is experiencing the irrational mode, meaning that the market is selling it panically because of some of the macro backdrop, stay poised, stay calm. Back to the very fundamental question. What's the point of me buying this company or this unit trust? It's because of we believe at the fundamental. So we asked the fund managers, are they still positive regarding to all the fundamentals, the companies that they are holding? Are they still positive on it despite the share price has been not doing well? The answer we get from the fund manager is quite positive. They are still having a positive view. They are still holding a belief of the companies that they have researched, they have investigated, they have spoken with the management team. They are still having a positive view. So to be honest, being a research analyst in FSMOne, I do think that this kind of replies is a positive to us as well, because we gain confidence. We know that the fund manager, they are still confident on the holdings that they have bought previously, despite the unfavorable share prices. So yeah, that's pretty much from my side. Not sure, Jerry, if you want to add on anything.
And maybe I add on from the portfolio perspective, because we are also holding car funds for our Malaysia equity exposure. So I think on our point of view is that maybe I just also summarize from what Kevin mentioned. So from their point of view is that first thing first, the sell-off in Malaysia equity is more sentiment driven. Sentiment driven from the perspective of what Kevin mentioned. tariff. People are worried about tariff risk. But if you think from a perspective that nothing is concrete on Malaysia perspective, but people start selling off because of tariff risk. Trump started to impose tariff on China, started to impose tariff on Canada or Mexico. But if you look at the equity market, it's actually performing. But on the Malaysia perspective, nothing is concrete, but we start seeing the stocks coming down. So that's one thing. And the other thing, if you look at it, even before Trump got elected, he mentioned about universal tariff. And if universal tariff kicks in, from Malaysia point of view, there's no difference that US import from Malaysia or Thailand or Indonesia because they are imposing universal tariff on everyone. So that means that as importers, as a Malaysia, exporters, right, to export my goods to US, it's the same. US consumer, whether they buy from Indonesia sellers, they buy from Malaysia sellers, it's actually the same because they are imposing universal tariff. So for us, we are also seeing that the recent sell-off in Malaysia market is very much sentiment driven. Fundamentals, like what Kevin mentioned, is remain intact. And from a portfolio perspective, we have been with car for quite a long time. In our portfolio, since we included the funds into the portfolio, I think we are still sitting at double-digit gains on our portfolio level since we included it into the portfolio. But I also do understand that a lot of the investors might be seeing double-digit losses depending on the timing that they are coming in. So again, back to my earlier statement, don't blindly buy into a fund because it is a best performing fund. Sometimes it's really important for us to do our work, do our research to see that whether at this point in time is it good for us to enter into the particular funds, into a particular product. For a portfolio level, we don't see any concern of continue to holding into this fund because the drawdown, the sell off, or the decline, the losses in the funds, right, is not a fund specific issue. So this is something very important. If you buy into, let's say you buy into Malaysia equity fund, only this fund that lost 20%, the rest of the fund up 10%. This is something that you need to be worried about, the particular fund. But right now, the things that happen is that if you look across the board, all the Malaysia small to mid cap fund on a year-to-date basis, they drop 15 to 20%. And if the funds that you bought is within the specific range, it's not the funds issue. It's more of the country or the region that you are buying. Then you start evaluating the market, whether is it worthwhile for you to invest. And that's exactly our team are doing because we do study the market. After we study the market, we look for the products to buy for our investor. And that's exactly the value the managed portfolio is delivering to our investor.
I see. Yeah. It seems like the managed portfolio team, they are actually working very hard to filter the right funds and also trying to deliver a very impressive performance for our investors. So definitely this is also kind of assure our investors saying that, managed portfolio is still good, very good. You can actually consider put your money into it and let the professional to manage it on your behalf. Okay. I do see that there's a very interesting question over here. They are actually comparing about ETF. They're actually giving good dividends this year, 6.3%. And we are very happy with the return, right? So they are actually asking whether is it good to remain the money in ETF or they should just take out some of the money and go into unit trust or ETF. This is actually a very interesting question. I think maybe
I can answer. Okay,
you can answer.
Yeah. So if you look from, it depends on the one who is actually asking this question, right? What is your age? For example, if at my age of 30 plus, mid 30, if I put more of my money into EPF, right, I can't take it out. I have to wait until the age of 55, only I can withdraw the money. So in that case, I have 20 years of investment horizon. And we look across equity markets, right? If I can take slightly more risk, I put my money into equity market. Let's say, if I just want to, most of the, I think these are some of the statements that a lot of the young investor will be saying that if I just close my eye and buy into US ETF, S&P 500, I will have get 10 to 15% kind of annualized return. So if that in that case, right, I wouldn't be putting my money in ETF because I have a 20 years horizon to invest, and I can just put into equity markets to earn a much higher returns. That's one of the point one of the answer to it if you are at a much younger age. But if you are now at 55, 60, right, and you can withdraw your money from EPF anytime, or if you have more than 1 million in EPF where you can withdraw in and out anytime, I think on that perspective, actually is a good investment for investor. It can be part of your portfolio, but not all your money inside EPF. I think on the investor perspective, you also need to do your asset allocation. When I put my money in EPF, at the same time, I also want to gain exposure from the global exposure. I want to get some exposure into US market, into China markets, into, let's say, Japanese equity market. So to make sure that your portfolio as a whole is not lacking any growth driver. Because we know that from time to time, there will be certain asset classes outperforming the other. So it's very important for investors to practice diversification in their investment portfolio.
I see. Yeah, that's good.
Yeah, I think just something quick one to add on. I think the 6.3%, I think above 6% is not often...
Something rare.
Yeah,
Yes.
something rare, not often happening, right? So like what Jerry mentioned, just to add on, we really need to allocate, in terms of our asset allocation to have different asset classes or even different sectorial or geographical exposure that capture that. But if the client was saying that, but I still want that certainty, then maybe the client can consider including direct bonds or bond fund into our portfolio.
Yes, correct.
Then with that equity, put into a different exposure or sectorial, that would give them a exposure on potential upside as compared to a 6.3%. I think even bond now easily, recent bonds that we have issued can easily give 5 to 5.4%. Of course, the foreign currency one are giving 6%, over 6%.
Yeah, I think again, bond is definitely a very good, a very good element that you can include into your portfolio, especially if you are actually, like what Jerry mentioned just now, if you are above like 55 or 60 years old, right, you can actually consider put some of your money into bond as well. Yeah, just so that we can have a very diversified portfolio and you don't have to take too much hit when the equity market crashes, right? Okay.
I think there's a lot of questions from the chat box. Maybe we can start addressing them one by one.
All right, sure.
Maybe we can go to the top and start from the top.
There's an ETF, right? The
Which
WEN
one is
Act.
Too late to invest in Japan.
Would you suggest to invest in Japan, big cap or small cap?
Small, mid
Kevin,
cap.
you want to take?
Small to mid cap.
Okay, Japan, we are still
Quick one.
positive. For mid cap and small cap, big cap and small cap, we think that a balanced approach between big and small cap will be good enough. Japan, structurally, still a lot of catalysts. Their economy is normalizing. Their semiconductor sector is growing. Even some of the equipment here, Sony, Canon, these big companies are located in Japan. Then, in the near term, we do witness the normalization of the monetary policy, which is a positive signal to us, where Japanese, since their ultra easy monetary policy, which is an uncommon stuff in terms of the economic world, we are witnessing a normalizing in Japanese economy. So yeah, we are positive for the Japanese.
Yep, that's the green tick over there, a green buy call. All right, and then what are the
Renet Semicon.
Renix, Semicon, and
Vanguard
S&P 500 ETF. Given the market now, is it a good time to invest in a US-based ETF? I think I'll just take the question quickly.
Yeah.
I think this is not really an apple-to-apple comparison because the S&P 500 tracks represent the US equity as a whole, where the semiconductor VanEck ETF only represent the semiconductor industry. So I think both are actually on our regular saving plan.
Yes,
Right.
correct.
So, but let's talk about semiconductors. I think the semicon industry are huge. The potential upside is big. Right. I think the future trend, you're looking to digitalize a lot more, right? Of course, the Western country, they have already started way earlier, compared to the emerging market. Where the emerging market, I think there are a lot more room for that, right? So I think, of course, this year we are expecting a lot more volatile on the capital market in general. So I think, yes, you still can buy. Whether it's a good time, I don't think there will be always a good time. I think you need to stay invested. So what happened is that we understand markets goes ups and down, right? So I think for this semicon ETF, I think the client can just apply a regular saving plan and invest to it. Yeah. I think whereas S&P, I think coming down all the way from the previous high, I think even the Fed may not know where US economy is heading, right?
True. Yeah.
So I think, but in the long term, right? If you're looking at long term, 5 years, 10 years down the road, if the investor still thinks that US is where the giant economy is, then you should keep investing into it. But you can do it on a regular basis. Regular saving plan, maybe a month, 100 ringgit. Right,
Yep,
you potentially buying higher, could be buying lower, right? But you will ignore that volatile, embrace that volatile, through this strategy.
Yeah.
Or maybe I can just add one sentence to conclude to answer this question. Our target price for this ETF is 301.
301.
Yep.
Target price.
Yep.
Okay. There you have it. 301. Okay. I think for now, let's just take another...
Maybe we go quickly into each of these questions, right?
Okay. Can.
Yeah. But apart from tech, what other sector that we look at? We can look at to invest, and also the market outlook. Maybe I will just take these two questions together.
All right.
For equity markets, beside tech, beside US market, we like Japan. We like for now we like China because we think that China is the horse for 2025, China A.
Yep.
And I think on top of it, I think Malaysia equity is something that investor it's worth to look at for investor portfolio, because these are the three key segments that we are overweighting. Japan, Malaysia, and also China A. Yeah.
Alright, so from now, what we just now Jerry mentioned is Japan market and also Malaysia market, right?
And also China A. I think these are the three markets that investors can look at it. In fact, for Malaysia market, I think with the recent sell down, Malaysia has come to a very reasonable level, a very undemanding level, which an investor can really look at it to include into the portfolio.
I see. At a very attractive price point right now. Okay. Alright, so...
What's the difference between share listed in China versus share listed in Hong Kong?
Hong Kong.
Yeah.
Maybe I can take this question. I think the differences between stock listed in Hong Kong and versus stock listed in China, I think these are what we call dual listing. The major difference is that the regulation, right? The China A share, which is a northbound trading, that means going from Hong Kong to mainland. That only what is tradable is only those index shares, right? So if that particular stock is not on the index, then through China A share northbound trading, investor cannot be trading that. But whereas for the Hong Kong, it's more liberalized, it's more loose. Having said that, whatever is on the Hong Kong, listed on the Hong Kong exchange, our client can just trade that. So I think that's the two major difference between China A share listed and also Hong Kong.
It will be easier for investors to access the market, right?
Yes, which is the one in Hong Kong.
I see. Alright. Okay. Let's see if there's...
China share is still a good buy. I think we have answered that. Between China and US, Greater China, which should we put our money? Yeah, I think we mentioned China A over Greater China, and US and China both also our call for now. Yeah.
So China is actually on our radar. So perhaps for investors who have not exposed their portfolio into any of the China equity like unit trust or ETF, maybe you guys can look into it, or you can actually check out our key investment team. So from there you can actually get some like fun unit trust suggestions from which are being selected by our research team. Okay, perhaps maybe we can take one last question. Gold prices. Would that be a very good one to to conclude to kind of like end our session here? So gold prices has been hiking up crazily. I believe one of the main reasons is probably from the market volatility, right? So a lot of our clients is actually asking whether is it something that they should look into, and also to add some exposure into their portfolio. Do you guys think that it is a good options for them to include it into their portfolio now? I think maybe
He said
Kevin
yes.
can-
Okay.
Yeah.
He put yes, I put no.
Oh, yeah?
Maybe
It's a no
maybe you
for
can
me.
let him elaborate first.
Oh, no? No, yes.
Yeah.
Okay.
Okay, so
Please.
to address your question,
Yep.
if you are asking the question where should investors include gold into their portfolio, my answer will be yes. But if your question is should investors buy gold, then my answer will be no. Why I say so is because we think that gold, ultimately, they don't have a very structural fundamental to drive the share price upwards. Meaning that currently the gold price is trading at about 3K ounce per ounce. But what's the reason behind it? Because of uncertainties. Can anyone on the street assured that these kind of uncertainties will become more severe, or it will become those things will be settled down in the near future? No one have the right to say that. So ultimately, gold, personal view, I think that we should view gold as an hedging tools for inflation, instead of viewing it as a tools to gain capital appreciation. So yeah, if you would just want to view gold as a hedging tools for inflation, we think that include it into your portfolio in a portion that you are ready to accept, ready to take the risk, then it should be fine. So yeah, my answer is you should include some portion of portfolio with gold because you want to hedge against uncertainties.
I see. So the main keywords here is to hedge against uncertainty, and it's only for investment purpose, not buying into real gold, right?
Not speculation.
I see. Not speculation.
Yep.
All right.
Maybe I elaborate a bit. No.
Oh yeah, please.
Yeah. I think very straightforward answer. Today I buy gold don't pay me any income. Instead of buying gold, I might as well buy bond. They pay me income. If I buy Malaysia MGS 4%, why not? I mean, thinking from the perspective of safe, right? I think government securities, T-bills or MGS is safe enough for me to hedge against. And consider that for the past 1 year, gold price up more than 50%.
Yes,
That will
correct.
that together with gold not paying any income, these are the two factors that why I'm showing a no for including gold into my portfolio anyway.
Yep, similar for me. So I think I coming from a relative basis.
Different perspective, I would say.
Yeah, I think relative basis, is comparing bonds versus gold. I will go for bond.
Definitely. I understand.
Yeah.
Because they are paying coupon payments also. So doesn't matter how the market goes, you will still getting the coupon payment from it. Yeah. But again, I think Kevin is also bringing up a very good point, saying that it's a very good diversification element to your portfolio. So having a little bit doesn't hurt anyone. Yeah, in fact, maybe it can also preserve some value of your portfolio, a bit of your capital. Okay, I think that would be it for our webinar. So before we end this, right, perhaps since we have 3 of our guests here, right, perhaps they can actually give out one word to our investors. So perhaps this word can be something that you can actually very encouraging, empowering them on their investment. Perhaps maybe we can start with Kinon here.
Yeah, I think I'll start with the word cautious.
Cautious, all right.
I think why would be the word cautious is because I think this year we're talking about a lot of uncertainty.
Yes.
Yeah, so I think as a smart investor, right, of course, we will expect that the market to be rosy, delivering 10, 20% in a year. But, if you look back on all the financial crises, these are the times where people are being too over-optimistic that, the market is going to deliver that sort of numbers, right? So I think being cautious is something very important, especially a lot more uncertainty, this year around in the capital market. Yeah.
I see. What about Jerry?
I think in order for you to be cautious, you need to have a portfolio. So I'll suggest the word of a portfolio because considering that when we look at our investor data, our investor portfolio, the way that they invest, investors tend to have the behavior of over-concentrating into certain segments. Like in the past, they might be concentrating in China markets because given that the strong performance of China markets from way before 2021, right? But lately, we have been seeing investors concentrating in Malaysia equity, concentrating in technology. So I think when it comes to investing, I understand that for investor point of view, it's always returns. But what is more important is that to invest in a more sustainable basis. Meaning to say that you want to make sure that your portfolio can grow sustainably over the time. And I think the way to work it out is really on a portfolio basis.
Understood. So portfolio. What about Kevin?
My word will be calm.
Calm. All right.
Well, this year, especially if those people who are already, we use the word trap at the height, meaning that they bought the market and when the market is near to the peak. Probably they are quite panicked right now. And it's going to be irony because I will use the word calm. So let me bring you back to the year of 2023 when the market is keep on rallying. At one of time, I believe that if you look at the market, even some people are saying that, oh, this kind of rally is unsustainable. AI is bubble. Try to imagine metaverse. We have experienced that. NFT, we have experienced that. It is a bubble. It is a scam. But today we are witnessing AI development is ongoing. And I believe that some of the most common tools like ChatGPT, even Deepseek, Grok, a lot of big companies, they are utilizing AI. 1 year ago, 2 years ago, during the Russian-Ukraine war, people are talking about inflation. People are talking about nuclear war. People are saying that it might be a catastrophic event for the entire market. But what happened? Nowadays, we are still sitting here, we are still discussing with our investors here about the market. And imagine that if at that point of time, you are not calm at all, you are panicked, meaning that you liquidate all your assets, you're going to be lost out all this rally since the Russian-Ukraine war. And another example, COVID is also one of the good examples. If you panic, if you don't calm, liquidate, you're going to miss out all the rally. So we are the unfortunate gang, and we are also at the same time, we are the fortunate one because we are at the era, we are witnessing the AI is changing the world. 10 years ago, smartphone is changing the world. 20 years ago, internet is changing the world. Now, we are witnessing AI is changing the world. So we are the fortunate one. And also, we are the unfortunate one because this, especially in this investment landscape, we are full of uncertainties. But let me give you another mindset. I just give you another suggestion. The uncertainties means that you have more room to gain a capital appreciation because you have the opportunity to buy at the dip. So yeah, I will encourage investors to stay calm.
Yep. Stay calm, be cautious, and build a resilient portfolio. Or you can just invest into the managed portfolio, alright? That will be a lot more easier. Okay, I think before we end, I can also, just give a little word as well. So my word will be understand. So you should, for any investors out there, be it like a new investors or you are an experienced investors, you should always understand yourself, understand your risk profile, and build your portfolio accordingly. Be cautious and stay calm. Okay, I think that will sum up our webinar for tonight. And again, thank you so much to all the viewers who are attending this webinar. And I hope that we do address some of your burning questions. But if you do have any other questions that you wanted to check with us or clarify with us, you can always drop us an email or you can just give us a call. So that will be it. So I would say, yep. Any last word? Nothing.
No.
All right. Okay.
Bye.
Thank you so much. Thank you for joining us tonight. And
Good night, everyone.
see you next round. Bye bye.